Imagine you are trying to figure out how much your friend's bicycle is worth. One way to do it is to look at all the parts of the bicycle, the frame, the wheels, the gears, and so on. You could estimate how much each part costs and then add them all up. This is similar to what asset-based valuation does for a company. Asset-based valuation focuses on a company's assets to determine its worth. It looks at the balance sheet, which lists everything a company owns, its assets, and everything it owes, its liabilities. The difference between these two is the company's equity, which represents the theoretical value belonging to the owners. Think of it like taking inventory. Asset-based valuation tries to answer, if this company packed up everything it owned and sold it off, how much money would be left after paying off its debts? There are different ways to value assets, and each method can give you a different estimate of the company's worth. Two common methods are book value and liquidation value. Book value is the simplest method. It takes the company's assets as reported on the balance sheet and subtracts its liabilities. This is the accounting value of the company's equity. Liquidation value is a more realistic approach, especially if a company is in trouble. It estimates how much money the company could get if it had to sell all its assets quickly, perhaps in an auction or a fire sale. Imagine a bakery going out of business. The book value might show the ovens are worth $10,000, but in a liquidation they might only fetch $5,000 because buyers know the bakery is desperate to sell. Now let's go back to your friend's bicycle. Instead of just looking at the parts, you could also consider how much money your friend could make by renting out the bicycle. This is similar to how earnings-based valuation works. Instead of focusing on the past, earnings-based valuation looks to the future. It tries to estimate how much profit a company will generate in the coming years. The idea is that a company is worth what it can earn for its owners. This method is like valuing a fruit tree. You wouldn't just look at the tree's size or the number of branches. You'd want to know how many apples it's likely to produce in the future. Methods in earnings-based valuation, from multiples to discounted flows. Earnings-based valuation also has different methods, each with its own level of complexity. Two common ones are using price-to-earnings ratios and discounted cash flow analysis. Price-to-earnings, or P/E ratio, is a simple method. It compares a company's stock price to its earnings per share. You can find the average P/E ratio for similar companies in the same industry and use it as a benchmark. Discounted cash flow, or DCF, analysis is a more complex but potentially more accurate method. It projects a company's future cash flows and then discounts them back to their present value using a discount rate. Think of DCF like calculating how much you should pay today for an investment that will give you a certain amount of money in the future. Choosing the right valuation approach. Context matters. So, which valuation method is better? Asset-based or earnings-based? The answer is, it depends. Asset-based valuation might be more appropriate for companies with large tangible assets, like real estate or manufacturing companies. It's also useful when a company is in distress and its future earnings are uncertain. Earnings-based valuation is generally more suitable for companies with strong growth potential and those in industries where intangible assets, like brand recognition or intellectual property, are important. Just like you wouldn't use a hammer to fix a leaky faucet, you need to choose the right valuation method based on the specific company and situation. Are you ready to unlock the full potential of your business and captivate prospective buyers? Imagine having a clear, compelling analysis of what your business looks like to a discerning purchaser, highlighting its strengths, addressing its challenges, and showcasing its future growth. This isn't just about numbers, it's about telling the story of your hard work and dedication in a way that resonates with buyers. Don't leave this critical step to chance. Schedule an initial consultation at www.jamesmontgomerylaw.com and discover how a comprehensive business analysis can transform your selling journey. Let's take this pivotal step together and make your business sale as rewarding as your entrepreneurial journey.